Another episode where we didn't get to everything on the show notes because there was just so much to talk about.
Yeah, but we kicked off talking about our new segment, which for a better name, DeepdiveMcDeepDiveFace. We touched on our first sort of content, which will be coming out around the go-to-market strategy and sales funnel.
Yeah, would love any feedback from listeners for our high-level thoughts and any topics you'd like us to discuss.
Yeah, and then we jumped into Tech Council of Australia released a report at South Start, and that goes into Australian tech roles, it goes into the regulatory system, and it looks at talent. So we go deeper into that, and that flows into some other data just out of Carter around the continued rise of startups that are shutting down.
And it's not just shutdowns. We also talked about valuation write-downs after a couple of articles, particularly talking about Blackbird writing down some of their portfolio while others were written up in their value.
And then we spoke about a LinkedIn article discussing are VC-backed companies just underachievers? And we gave some thoughts around that.
Yeah, not triggered much at all. And that led us into Breakthrough Victoria, which is under a lot of pressure in the media. And we give our thoughts as to whether Breakthrough Victoria should exist or not.
Which also led into a bit of a chat about main sequence and some commentary about whether taxpayer funds should have already been returned. And we touched on deep tech and the event horizon for investments in that space.
We then touched on SquarePeg, which discussed some of their fantastic returns.
Crossing the $1 billion returned to LPs, which is amazing. We then discussed the companies are starting to buy other companies. There's a whole lot of M&A occurring, including Culture Amp and Canva.
And then the IPO of Reddit and how this might be the start of some positive times in the IPO market.
Whilst looking at how this whole AI space is changing the world and our view that technology differentiation is going to zero, and we play a little example of an AI that actually builds a little program by just text command.
And then we talked about how much life we have left on this planet as we head towards a singularity and domination by AI, and a prediction by Dr. Ray Kurzweil that we'll hit that point by 2029.
And there's at least another 5 years of looking at charts, but I think this time was quite interesting because we went into the unemployment rate, some things that we're seeing and some precursor to the unemployment rate. But because it's Easter, we also discussed the price of chocolate and the price of cocoa, and we looked at the futures markets and why cocoa futures have gone from $2,000 to nearly $10,000 in a very short period of time.
It'll be a measure of our influence if there's a run on Easter eggs at Coles in the next week.
Let's get into it. How are we?
Great.
Going good.
Another week. These fly by.
Another day in paradise. It's absolutely pissing down 2 days before Easter. Jack looks like he's basking in the sun over there.
Yeah, I don't want to brag, but it's going to be like 29 degrees on Saturday. Like it's fresh in the morning, so you sleep well, but it's nice during the day.
Arrogant.
Yeah. Some sort of rain bomb is predicted for Brisbane this weekend.
And Aaron, you've just been up at Townsville?
Yeah, Thursday. Yeah, so ran an investment readiness session and had office hours. And I'm going to say Townsville punches way above its weight. They were really good companies. And there's some good pedigree there. I mean, safety culture came out of Townsville. The founder of Fly Freely is from Townsville. Jesse just recently got acquired out of Townsville. There's some good companies up there.
The best Peking duck I've ever had is from Townsville.
That's right. You said that.
You said that a few
get a chance
times.
to-
We need to validate this.
You know what I'm like? When I'm on something, I repeat myself. This was very good. This was repeatable duck.
Repeatable.
And Jack, you've been at some pitches and meeting with some companies?
Been a bit on. Yeah, a few things going on in Adelaide.
Good to see. I went to the GC Hub event last night for the launch of their new space down the Goldie.
Yeah, how was that?
Yeah, it was really good. So there's 5 founders there that are very interested in our London mission, but just good to reconnect, and shout out to Sharon Honeybell and keeping the GC Hub going. This would be their 3rd space now, but keeping the dream alive, which is good.
Yeah, great.
What about you?
Yeah, Don, you've had a eventful
You had
week.
an interesting weekend.
For 41 years, I've had perfect teeth, no fillings, no braces, no anything else. And then I was in a hurry to get to the Brisbane Angels conference, and I was setting up the caravan with the family and was not concentrating. And those that have a caravan know that you put the leg down with a hand winder if you're an idiot. If you're a real caravaner, you buy a power drill. So then that way, instead of taking 4 seconds, you can do it in 1 second. These are important amounts of time. And it jammed and the drill came up and smacked me in the mouth and broke my front teeth. So I didn't get to the Brisbane Angels event at all. I had to try and find an emergency dentist who has done a pretty good job at the moment. But in a couple of weeks, I'm going to have my wife come with me and hold my hand, given my irrational fear of needles and dentists. And given my father-in-law is the dentist, he likes to extract fear, pain, and everything else out of me while I'm lying in that chair. So
I shouldn't laugh, but I can actually picture the way you described it. I can picture exactly that happening. I can see myself doing something like that. Just far out.
couldn't
Gone
believe
in a
it.
rush. That is just a classic.
And then it pissed with rain the whole time. So it wasn't like we ended leaving stressed and strained and doing all the normal damage to family relationships that those holidays tend to do. So
Far out.
And then off to the farm
Anyways.
this weekend done.
then off to the farm to do it all again this weekend. The last time we went there, we had to abandon all of our cars, all of our vans, abandon everything, walk down the mountain and get picked up at the highway by my very judgmental brother and my uncle to then drive us back to safety. So we're hoping that doesn't happen again.
An incident-free weekend. You've had a run recently between Maggie and hospital, you in the dentist,
Yeah.
logging vehicles at farms.
While we're on the theme of Gold Coast announced some funded places, and then I believe some other funded places got announced as well.
Yeah, so we have 10 places being sponsored by the City of Gold Coast. So if you're a Gold Coast venture or a founder based on the Gold Coast, you can apply for our London mission, 10 places on our UK mission in June. We've already had a heap of applications come through, which is great. And we have another 10 places in Queensland, which we can't officially announce just yet, but there will be more to come. So all up, now we have SA funding, GC funding, and more coming for Queensland.
I note on the show notes, it just says hint. So I apologize. And if you need me to edit that.
No, we're all good.
And what's the importance of a mission? Before you go and spend time, effort, and often hundreds of thousands, if not millions of dollars, it is best to get into market. And it just saves a lot of time and a lot of heartache. Join in with 20 to 25 other founders, and the tribe team facilitates a range of workshops, introductions. It's a good way to establish if the market's for you.
Yeah, absolutely. And one of the common questions is, am I too early or am I too late? Neither case is true. In the last UK mission, we had companies from 20 mil ARR down to pre-revenue. So check out all the details on the tribe website.
All right, closing the loop on some stuff from last week, we put forward that we were going to start doing some content deep dives, so going into particular topics as a standalone episode. And we asked, were there any suggested names? Because Aaron, you raised DeepdiveMcDeepDiveFace. We had multiple people that came back and said, that is the theme that would most align with our brand. So our first DeepdiveMcDeepDiveFace episode is going to come out next week. And on this one, it's going to be go-to-market strategy. And we're starting with that because that's where we see the most amount of confusion. That's where we see the biggest difference between companies that are successful and companies that are not. The ones that are successful get really clear on their go-to-market strategy.
This really comes from where we spend a lot of time with portfolio codes, but also where we get stuck looking at some of the deals that come in, and where we spend a lot of time looking at inbound deal flow. I want Jack to fire up because this seems to be a passion point for you, Jack, when you get fired up on this topic. Like the confusion around GTM and sales funnels and not measuring metrics, and the confusion of sales and marketing as if it's this one thing. I want to put you on your soapbox.
Yeah, where do you want me to start?
Pretend you're Don, go outside and start shaking your fist at the cloud like some irrational old boomer.
So yeah, the way I look at it, go to market it's a strategy, and all I need founders to do is align on a strategy and tell me this is where you want to go and this is how you're going to do it. And it's fine for a strategy to be wrong, but I just need you to align and agree this is where we're going to go and this is where we're going to commit. And then when we talk about a sales funnel or a one-pager, they're basically just a tool to evaluate whether your strategy is working or not. And if you're getting data which is telling you that it's not, change the strategy. And we're not in the position to tell you whether or not your strategy is right or wrong. We can give you hints. And really that's just because of the sample size that we've seen from so many pitch decks that maybe you are on the right track from starting out. But ultimately, you've got to use these tools to evaluate whether your go-to-market strategy is working. And I just think that's often confused and people think it's one or the other. Like it's either go-to-market or it's use a sales funnel, but really they're complementary. So yeah, I think I'm looking forward to doing a deep dive and hopefully break down these things, and keen to get any feedback that anyone listening to what we've got to say today or on the deep dive.
Yeah. Trying to get it really simple as well, but not simplistic, because there is so many different moving parts. But at that top level, when we see a pitch deck to begin with, what we're trying to really understand is the core components of, all right, for this go-to-market strategy, who are you going to target with what product and service? And then what's your marketing and sales engine going to be in order to fulfill the who, the what, and then the how? And now there's a whole lot of science in the full length podcast we'll go into, who you should target, what are their attributes, what's the ideal client profile, niching, where does brand alignment fit into that? And then product as well, product and service. We'll unpack that in terms of there's going to be different features and attributes and pricing, but ultimately you can have the best product for a great ideal client. But if we then don't have the marketing and sales engine, now note, most of the world says sales and marketing because sales is what is most important. It's the cash flow, even though M comes before S in the alphabet. But the marketing side, unless that is sorted first, you're going to find it really difficult in that sales side. You've got to generate demand and then you've got to convert it. Unless you've got demand for your product, you've got nothing to convert. And if you don't have the sales functions, even if you do have demand, you won't convert.
Yeah. And then breaking down those elements on the demand side, but also on the conversion side. And it's one thing to get customers, it's another to keep them and another to grow them and build that viral referral system as well. So we've tried to distill it down into pretty much a single page template that you can populate, and just the process of going through each of the elements of itself helps you identify where you've got some weaknesses or gaps and you have to go back up and perhaps reinform strategy and change and go again.
In time, sure, we'll allow people to provide a pitch deck, but I think actually the first evaluation, once we have this finalized, will be go to the site, fill out your go-to-market strategy canvas, and the first pitch call is actually on that. Because too often pitch decks don't deal with these issues. And then the problem is we could be passing over something that potentially could be a good deal, but it's just not articulated in terms of what we need to see. And then conversely, from choosing deals, often it's pretty easy for investors to get enamored either with a shiny product or a big problem or early traction that the founders have been able to get, but there's no systemic way of generating demand and converting. And then that often doesn't present itself until you're fully invested and then you found out that it was just some low-hanging fruit. They have no ability to cross that chasm, and then you're stuck in a really tricky situation. So my vision, although some may say that's too anal and too prescriptive, is to actually start with a canvas like this, because then we got a bigger picture of what we're actually trying to establish here.
Yeah, I would draw far more understanding and insights out of that one pager than out of a standard pitch deck. I think it'd be an incredibly interesting experiment to run.
We'll soon find out. We go from having a lot of deals a week to none because nobody wants to play with us because we're arrogant assholes forcing people to do things they don't want to do.
But regardless of if you use a framework that we provide or not, when you speak to an investor on a call, make sure you've thought about your strategy and how you're going to acquire customers. Because there's nothing worse than getting on a call with a founder who's pulled a quantum that they want to raise capital for with no thought behind why and how they're going to do it. And typically it's give me the money, then I'll go and find how I'm going to do that. But really it's got to be the other way around. And you don't need capital to think hard about how you're going to do this and look at the data to get the feedback.
Yeah, especially at the stage we play at, like the grassroots ingredients of a scalable sales machine is something we're really looking for. And it doesn't mean that the founders have to have all of the answers, but to have done experiments, to have some informed thesis, and we have some conviction at the team's ability to execute. And if it doesn't work, to pivot and iterate and go again.
I think that's the key. That last bit is really where we're putting a lot of effort into. To Jack's earlier point, we're not clever enough to tell you that this is exactly going to work or not work. It is really challenging when it's clear things aren't working, but founders are wedded to the past or wedded to beliefs that are just not ringing true in the data. And more, we're going to find people that can pivot quickly, deal with the reality, look at the funnel, make the changes. They're the ones that are going to win. So we're putting a lot more effort into finding teams of people that we're confident can do that, without imploding and self-destructing.
Yeah, I like the Hormozy definition of founder intelligence. And that's when you're in a situation, you do certain actions and it fails. The next time you're in that same situation, same ingredients, doing a different behavior to try and get a different outcome, as opposed to just keep repeating the same behavior and still failing. And I think that's what we're really looking for, the founders who can learn and iterate and keep going.
All right, well, look out for that. If there are specific things that people say, please make sure it covers this topic, or this is where I'm struggling with my marketing and sales machine or whatever, please reach out to us. Care of DeepdiveMcDeepDiveFace. So let's jump into some news. So the Tech Council of Australia released a report at South Start, and the report focuses on talent, investment and regulation in the Australian tech scene.
Yeah, Tech Council of Australia. We haven't talked about it much. So this, if you're not familiar with it, this was Startup Oz, which then became the Tech Council. And Lainey and I were on the board of Startup Oz for a while. But this report, I don't know, it's been interesting that they've looked at, talent and identified that tech roles are growing 4 times faster than other roles in the Australian economy. And they're predicting this shortfall of 600,000 tech workers by 2030. Sounds intuitively correct. Like, I think in a world where people can work remote, it's probably going to be sourced talent from elsewhere, but does identify an opportunity in the market for school leavers and those that want to retrain. And then on the investment side, I think what's interesting, there's a lot of talk in the market here about, do we have too many VC firms? Is there too much capital sitting in dry powder waiting to be deployed and so on? But what this report says is that at the angel and seed stage, at least on a per capita basis, Australia is still pretty far behind, investing $12 per capita in Australia versus 21 in the UK and 34 in the US.
And we're about to make it harder, potentially, with changes to the sophisticated investor rules. So that makes a lot of sense.
Yeah. Yeah, it's interesting. If you look just purely on a per capita basis, there's a long way we could still go. That's obviously assuming that we have the deal flow and company formation. So it should be paired with that data. But then the other part of the report was saying that we're going to have a $53 billion scale-up funding gap by 2030, which I'm not reading the report, I wasn't entirely clear how they came up with that number. But again, I think it's going to be sourced from overseas, but just highlights an opportunity in the market.
Yeah, there's a chart in there, and I'm not exactly sure of the data set, but it puts forward that, especially in Series C and Series D, in Australia, the percentage of companies that are surviving past those rounds is lower than the US. I think that probably makes sense because A, US capital environment's much bigger. B, US is far more failure friendly or willing to give people multiple shots, versus the Australian culture is still very much, if you screw up anything, the tall poppy. You've only got to see that last AFR article on Airtree straining to try and make some massive mountain out of a molehill that potentially 2 partners, one that's retired, don't see eye to eye. Fucking hell, that's news.
Yeah.
I think we're all in trouble.
And the other part of the report was just calling for regulatory change, which the main ones there to shout out, with more certainty around IP protection of AI generated content and assets, and also allowing for more competition in fintech. So I guess the role of Tech Council Australia is to make sure we have a vibrant startup ecosystem, which segues into looking at the shutdown rates that are rising. So this data came out of Cicada, looking specifically at companies that shut down after having raised 5 million plus. And what it basically showed was it's on the rise. It's been on the rise quarter from quarter over the last, 18 months, and hit a peak of 61 of those companies from the Cicada database.
But that's only for January and February. That's not even the full quarter.
No, and that's 61 out of 447, I think. Yeah, so actually, no, that's not right. That's shutdowns. Yeah, so 61 just in the first 2 months of January off the Cicada platform had shut down after having raised 5 million.
And another chart there is it's across a whole range of ages. But what's interesting
for me in that second chart is partly this is expected, and we've talked about it before, post the COVID bailouts and the free capital pre-love era of 21, we've been expecting this, but the data is showing that the years until death is decreasing. Like, companies seem to be now failing faster. Admittedly, there is a lag in the data because those last few years, we'll still wait to see how the rest of those vintages play out. What's interesting is the companies that started in 2017, like close to half of them shut down in 2023. So 6 years later. And then if you look at companies formed in 2018, it was half of them failed 5 years later. Then in 19, 4 years later. So it seems to be that companies are shutting down earlier and earlier.
I think that makes sense, that if capital was easy during that period of time, more ideas were getting capital, more ideas that probably didn't have go-to-market strategy nailed, didn't have those proof points. Then by the time there's been a downturn in investment and investors are looking at companies that haven't been able to achieve what they said they would, they're just not getting full-on funding.
Yeah, I think it aligns, like, as interest rates go up, we've gone back to fundamentals, and ideas that aren't viable are being funded. And the ones that maybe survived longer than they should have now don't have the luxury to continue, and they're now dying.
And investors are far less tolerant. If you're not hitting forecasts, they're not following on to keep it alive. This also segues into an AFR article that was talking about, it's not just shutdowns that we're seeing, it's also valuation write-downs. And the particular article by Nick Bonyhady talked about venture capital investors in the $300 million self-driving car startup Baraja have written down their stakes to zero. And they referenced Blackbird having written down the value of their investment in Baraja, but at the same time still saying it's fundamentally a good business. We still believe in them, but they've just struggled to really get revenue. The article went on to say that the following financial year, they had a $41 million loss off a revenue base of 400,000. For me, that piece, you would naturally expect to see a revenue loss after raising capital because that capital is presumably being deployed, but the revenue base is pretty low, like 400K revenue base.
Like, deep tech aren't a traditional business model. This is a self-driving car sensor. It's not, the balance sheet and the P&L isn't going to look like a traditional business, especially early on.
Yeah, exactly.
Deep tech can be challenging because those revenues can be so distant. But in this instance here, I'm getting a feeling that they expected revenues a lot earlier, but there's just either some kind of product market fit or go-to-market problem that they suffered, because if you have a look at some other big deep tech companies that have no revenue at the moment, their valuation is rising, and it's rising because they're progressing and their products are developing and investors have confidence. In this instance, they've written it down to zero. So that tells me that it's some other issue.
Yeah, agreed.
Yeah. So it's not just Baraja that was written down in Blackbird, but there's been other valuation write-downs as well in the Blackbird Ventures portfolio, which we saw coming. Like, we know when we were in the UK in June last year, we heard about UK VC starting to write down portfolios. It seems like there's a little lag here in the Australian market. But this was in an article in the AFR talking about Blackbird's investment in Culture Amp, which was marked down 21%. Their investment into healthcare startup Eucalyptus was marked down 6%. Workplace Safety Culture's valuation increased by 30% though, or around 15.4 million. And Canva's valuation increased by 9%.
Yeah, win on one hand, lose on the other. I think the valuations that did get written down though, those underlying companies have been doing quite well. So they're growing into some of those valuations to only be written down by those percentages, given the way the market's corrected.
Yeah, that's a really good point, actually.
Yeah, I don't think, like, for listeners, there's not much weight behind this article. This is a private company. Like, valuations loosely follow the public markets for tech companies. Fundamentally, Culture Amp, Eucalyptus, like, they're all really good businesses. They're going to continue to grow. So, like, this is just part of the game.
Yeah.
But on the theme of write-downs and business performance, there was I guess you could call it snarky, a post on LinkedIn by Dirk Schalmer, cotton patterns that he sees: VC-backed founders, confident underachievers, bootstrappers, insecure overachievers.
I love that. It really hit home. It made me self-reflect a little. I think there's absolutely times in my life where I've been the confident underachiever. I think my marathon performance might be... I do remember a comment on one of my school report cards that insecure overachiever. And then it made me think, Don, should we give up on all this kind of self-improvement, understanding ourselves and just remain totally insecure? Maybe that's the secret.
I think they exist on both sides. I had a chuckle at it. Are there people that raised too much money too early that became confident underachievers that are bootstrapping? Yes, but I do agree with the sentiment that when you are bootstrapping by yourself and you're really driving that resourcefulness, it's hard to be secure when your business isn't secure. And in the moment, it doesn't feel like you're achieving a whole lot, but actually you are achieving a huge amount. I would say founders that we've probably tried to over-index in only the paranoid survive. And they are really striving to be overachievers for themselves, their market, their customers, their family. But this game has to have a little bit of insecurity in there, because if you think you've got it all worked out and nailed, you're going to get into trouble.
Yeah, very true. And we've seen this play out, when we talked about before, insecurity can be a real driver and different manifestations of insecurity. But entrepreneurs that are driven by some sort of chip on the shoulder or something to prove or some really burning desire or need tend to outperform the others that are in a place of total comfort.
Yeah, I just think if you putting aside confident versus insecure, I just think lots of capital versus bootstrapped, the mentality there. And that's why the bootstrapper wins. It's that resource constraint, got to get more out of less. And therefore you've got to find a solution. Like from day one, it's not pour $10 million to have no efficiency and then find the solution. Like it's just a totally different mindset. And when you don't have 100 mil in the bank, it's a lot easier to drive the team around this mission. Everyone aligns to it. This is where we want to go.
Yeah. And in the last few deals that we've been looking at, and it's probably an area that we're going to play more on, the company has come to us for a much larger check. We like the founding team, we like the business, and we've gone back with, hey, why don't we do a much smaller amount? Let's put it towards some specific projects. Let's take a more constrained mentality, demonstrate that works. Then we can go out for a much larger amount at a much higher valuation because you've proved it. There's no ambiguity anymore.
If I was a founder, when you raise capital, the more you raise, the more you dilute yourself. Unless you have built the machine, you don't want to raise a heap of capital if you don't need to. Raise the least amount, prove and do everything you say you can do. And then when the machine's repeatable, efficient, reliable, like you're ready to pour capital onto that, then go and raise it. Because then you can actually put the capital to work.
Yeah, it's a good point. There's a really interesting founder up in Townsville, great business, bootstrapped through to this point, and was looking to raise capital, raising a fairly decent chunk to enter the UK and the US at the same time and go after a different vertical. And the thinking was, if I'm going to raise capital, I may as well put that effort into raising once. And I'm not sure about the macroeconomic climate and where that's heading. I should get capital while I can. But talking that back through to what's going to lead to the biggest valuation lift, like what's that first milestone? Raise enough to get to that point. And at that point, your business looks substantially different to today. And then you can raise on an entirely different multiple. You've de-risked the model. And by then as well, you may be making completely different strategic decisions about the market or about going into a different vertical. So you'll be in a completely different data set for making those informed decisions as well.
You're not raising capital from us to go and build the product. There's a lot more certainty around that. It's really the go-to-market, the sales and marketing engine. If you are pre-seed and there is so much uncertainty and a lot of things that need to be proved out, of course, you want more capital to have a safety to fall back on. Like the space we play in, we want to see you put the least amount of capital to work to prove it. And then there's going to be an inflection point when you next come.
Agreed. Now, with that uncertainty, part of the uncertainty is we don't know which ones are going to win and which ones maybe not. And VC is a power law game. And the power law game just really means that generally one is going to be the one that makes it all work. Now, the problem with that is that you're then going to have a whole lot of failures, things that don't work. And there's been a lot of noise and media reporting around Breakthrough Victoria, the $2 billion fund set up to effectively be a venture capital firm. Do we think that venture capital firms can actually be public entities?
In my view, no. Like if I look at where government has played a role as an investor in venture capital, the ones that I know of that have been successful would be Yozma in Israel, the Canadian model, and also one out of Scotland. But in all those cases, they were funds of funds. For me, there's a nuanced difference there in terms of reporting on fund performance versus the expectation of taxpayer money reporting on portfolio performance. And I think for me, like the very nature of VC, it's a private asset. There are information disparities, right? Like it's not a completely transparent investment. And yet public sector money has a certain level of scrutiny that comes with that and transparency. So personally, I don't think the government should be directly investing directly into companies.
On LinkedIn last week, it was Adir Schiffman said the fund was poorly conceived, suspiciously political, huge, opaque, using the wrong KPIs, an overly broad and unclear mandate with poor governance, and reporting that is slower than expected that provides little clarity. There's a lot of different things that you could unpack there. For listeners that aren't aware, we'll We'll put the link in the show notes, but the ABC did an episode on it as well. And here's a couple of criticisms that came out of that episode.
It's arguably the biggest bet the Victorian government has ever made.
Breakthrough Victoria is investing $5 million.
That we're going to invest up to $10 million.
$100 million university innovation platform.
A $2 billion venture capital fund that uses taxpayers' money to invest in startups and expanding businesses in the hope of making a return. Some see it as a high-risk gamble at a time when Victoria already has the highest debt level of any state at $126 billion and growing.
In this sort of startup space, the vast majority of them fail and you lose your money. It's opaque, it's bizarre. There's a question as to whether it just should be shut down as a bad idea.
My recommendation would be for them to shut it down, repatriate the money back into the Victorian taxpayers' coffers, which is badly needed, and not try and play in a high-risk, very specialised area like venture capital.
University innovation platforms. Only 17 of the companies are listed on Breakthrough's website, and not all investment amounts have been disclosed. Despite Breakthrough Victoria spending public money, it's exempt from freedom of information requests.
You're spending taxpayers' money. If you have to do it in a way where it's got to be secretive and you can't have the normal scrutiny of FOI or, transparency with details of your actual specific investments, I don't think the government should be in that space.
The Victorian opposition has also struggled to get answers to its questions about the fund and has referred it to the Auditor-General.
This is public funds. If the government refuses to answer any questions about how they're using that money, what return on investment they are getting, what value for money is this for taxpayers, what benefit is it bringing to the Victorian economy, I think there's serious questions to be answered.
As a VC fund, we give our investors an insight into how our companies are performing. We give a little bit of a taste into highlights and wins they've had, but also transparency into where we have areas of concern. We also like to provide some insight into how we made the investment decisions that we did.
Unlike private funds, Breakthrough Victoria doesn't declare the structure of individual investments, company valuations, or when it will deliver a return on taxpayers' money. According to its annual report, its only KPI is to invest in a set number of companies each year.
I think that all Victorian taxpayers are limited partners, that means investors, in Breakthrough Victoria. So I certainly hope that they can get the same kind of transparency and insight from the VC fund that's investing their future.
Breakthrough Victoria is also dealing with internal upheaval. 3 of its directors have recently called it quits. High-profile Melbourne investor Matt Rockman, who co-founded employment website Seek.com, questions whether the fund has the expertise needed to pick winners.
On the face of it, it looks stacked with academics, bureaucrats and sort of ex-government officials. And if you look at the broader marketplace of venture funds in this country and overseas, America's probably the lead market that created the venture capital industry. That's not the type of talent these firms attract.
Breakthrough Victoria's CEO Grant Dooley is on a $500,000 a year salary. That's more than the Victorian Premier. Breakthrough Victoria's headquarters are inside this city building, and there are concerns about the fund's operating costs. It employs 52 people, including former political staffers and public servants, at a cost of almost $10 million last financial year. It also spent another $1.5 million on consultants.
You've got to question the size of the cost base, the salaries being paid, the size of the team. Again, on the numbers we can see, it seems to be very, very cost heavy for a fund of that size.
There's no signs of any winners so far in terms of what Breakthrough Victoria will do, but it's often a long game, and sometimes it does take 10 years to get a payback. But I would have thought, shut it down now. Who's got 10 years to wait when Victoria's finances are in such a perilous state?
I look at it and say, would it be nice to be in a world where the government can get money into early stage businesses, especially companies that the private sector will find difficult? I think the answer is yes, but the how is important. And just like there are some companies that shouldn't be listed just because of all of the issues that come with listing, I think there are certain things that shouldn't be public. And I think in this instance here, this is one of them. As we just heard in that 730 report, there's a lot of stuff in there from people that don't understand VC or they don't really care, using words like bizarre and who's got 10 years to wait and no sign of winners. Well, it's only a couple of years old. And so really, I think we have a bit of an is one should issue. And would we want money to be able to go to early stage companies and should it be able to? But the reality, it's just, I'm not sure going to be the right conditions. And the media loves negativity. Well, not all the media, a lot of good journalists that cover this space, that understand how the world works, understands that there is a high risk of they're different, but broadly, nothing sells like a failure story. People love 2020 hindsight. They love to come after people and make them look like absolute fucking idiots because of certain decisions. And venture capital on a percentage basis is a high failure game. And so then what happens is you get people, then nobody wants to be in the newspaper on a negative basis. So that's going to drive a certain culture and a certain climate. Now, I can understand why they want to be exempt from freedom information, because from a commercial point of view, there's a whole lot of things that you don't want competitors in the portfolio companies getting to. But the problem is it's public money. Now, I agree with Jesse Wu of what normal VC funds do with reporting. Jesse was in the 730 report, but we as VCs do that to our closed LPs, sophisticated investors that understand the way the world works, investors that have an interest in that company succeeding, investors that shouldn't be taking that information and handing it out. To just say that we're going to do that same level of reporting for all companies to all taxpayers, like a lot of companies just wouldn't go to Breakthrough Victoria then. And I think the confusing mandate, like we're a VC fund, but then we're going to run competitions and then we're going to sponsor things. There's that saying, if you confuse, you lose. This thing has too many mandates, in my humble opinion. I was told the other day that I use my humble opinion too much. And because I use it so much, it's clearly not humble. And therefore, I should just say my arrogant opinion. So in my arrogant opinion, if you confuse, you lose.
When you say thank you kindly.
Thank you kindly. What are the other Donisms? Thank you kindly, scratching of the head, touching of the nose. May we continue? When you look at the staffing of it, like political staffers and bureaucrats.
Look, they're below the typical 2% of funds under management, but like 12 million a year expenditure. And the way there was a quote in there justifying it, saying, as a 3-year-old company, our focus is on refining processes, building relationships, and increasing awareness about our role that we can play in the market.
But this is one of the issues we saw with the NBN when it rolled out. It was a big shit fight that people were like, it's a government organization, it should have their shit together. No company gets born and then becomes immune to the life cycle realities of life. Even though they're a $2 billion fund, the company itself still has to develop. It still has to go through its life cycle. It doesn't yet have the reporting and the transparency and the internal decision-making and whatever else. And it now has to try and develop in public. I don't think it's got a chance. The NBN, at least, seems to have grown up and developed through some of those normal organizational development channels. And so, for me, if the government wants to achieve the end outcomes, there are better ways to do it. And at very least, when you've got certain styles of people that are trying to do a certain thing, and then you've got the media scrutiny, and that's going to have people starting to think a certain way, make certain decisions, view everything through the media lens. And once that starts to happen, you're fucked.
And the problem with this as well, the secondary flow-on effect is other governments, because all governments are risk adverse, and they're like in Queensland, the brief stint I had in there, it was always the Courier Mail front page test. What would this look like? Or how could this be spun by the media, and that risk aversion? And what happens with stories like this and examples like this is all the other programs get skewed in a way to avoid risk. And in my humble opinion, or arrogant opinion, this is exactly what happened to VCDF. It's exactly what has happened previously to other advanced Queensland programs, they just become misaligned to the original intent. And I think also there's the other risk with all sorts of public sector funding is that the short-termism, like looking at short-term cycles rather than long-term perspective. And yeah, it's interesting. Like, how do you unwind something like this at this point?
Oh, it's going to be, you just know what's going to happen. This is going to be death by 1,000 cuts. There's going to be self-interest protectionism. And I lament that the portfolio co's are going to pay for it.
Yeah, completely. And the other element of this is when we see the government as an investor competing with the other VCs in the market. And this is something we've experienced. But the very act, the government intent of trying to support the venture capital sector and see more venture capital inflows into startups. And they set something like this up, but it actually becomes competitive, government subsidized competitor to those already doing it. And so we end up in this cycle of what did you actually achieve other than a potential clusterfuck?
And that scrutiny on Breakthrough Victoria seems to have flowed a little bit to main sequence with an article by Nick Bonyhady talking about that the CSIRO has declared its ongoing confidence in venture capital fund main sequence, which has not returned $1 to public coffers despite receiving $175 million from taxpayers over 7 years. I personally don't think that main sequence and Breakthrough Victoria should be in the same.
Yep.
Sequence is a professional organization with actual venture capital professionals that has been developing deep tech, so long-term. I mean, it's only 7 years. Standard VC's, 8 to 10 to 11. Deep tech's going to be longer than that. But when you look through the underlying portfolio, the spokesman for Main Sequence said they had backed over 60 deep tech companies, which have a market value of over $6.8 billion and has generated 2,100 new jobs. I just don't think you can have them in the same sentence.
No.
Now, speaking of deep tech, Cicada Innovations is on the hunt for the nation's 23 most promising deep tech ventures. And they've got the country's largest deep tech conference, Cicada X Tech 23. Applications are now open for the next 3 weeks until April 12th. Founders keen to take part and present at the event are asked to explain the problem they are solving and what makes their approach and technology unique.
Good time to be a startup in terms of accelerator support right now.
Cicada CEO Sally Ann Williams said she's seen many startups that might not realize they're groundbreaking science-driven projects addressing major global challenges that actually qualify as deep tech. And in the article also talks about a lot of tech coming out of the regional areas that they want to try and support. Sally Ann's a great operator. I first met Sally Ann South Africa, actually, on a trip. Sally Ann, Trenna, Probert and a few others. That was many moons ago. What's the year? I'd say that'd be over a decade ago in the huts of Africa, working with entrepreneurs with a Creel Price organised trip. There were many things on that trip that will not be discussed.
But it's a big trip though.
Ultimately, what's VC trying to achieve? It's trying to achieve great outcomes, but it doesn't work unless money is returned to the LPs. And did you see that article that Square Peg has now surpassed $1.12 billion returned to investors and has an average multiple return of 6.1 times across 14 companies with an internal rate of return of 44%.
So good. DPI on the first vintage, which was 2012, is now at 4.6 times. So well done. And also just head down getting on with it, not making a lot of noise.
I don't know about you, but whenever I think of the big VC successful firms, just the Square Peg brand often never gets in there. It's always the others. But I think there's a cultural thing where it's just head down, bum up, being ex-founders. And there was an article in Startup Daily when Deputy did its raise and became a unicorn. And I think Simon was pointing out that he tried to talk to Square Peg. They didn't want to talk about it. They wanted to talk to the company who referred them back to the press release. Another investor that's in there is EVP. But there's just a culture there of head down, bum up, and just getting stuff done. Now, what we're also starting to see in the market is some acquisitions.
This is good to see because week after week, we've been saying how the M&A activity is down, IPO activity is non-existent. Good to see some M&A happening.
Yeah, so in another article in Capital Brief by Hugo Mathers. Culture Amp, which is used by 25 million employees across 6,500 companies around the world, including Canva, Atlassian, McDonald's, etc., is acquiring Orgnostic, which will help its customers unlock new insights by collecting, cleansing, and synthesizing people data from disparate sources across the employee lifecycle. So we see this often where successful companies start adding new functionality or new value propositions to their existing platform as a lock-in strategy, but it also plays into the 7 Powers framework, where it's not just lock-in, but it's around scale economies, network effects, those kinds of things. And whilst that acquisition sounds like an exciting one, the big one that was announced this week is Canva shooting out $1 billion to buy Affinit.
Not small change. $1 billion. What was the most recent valuation of Canva?
I think it's 40 plus billion, right?
Right.
On the cash on the balance sheet.
Affinity's parent company, Sier Financials, was founded in 1987, developing creative software for Windows and building a suite of apps over a 20-year period in the UK. So what I find interesting with this one, for a start, it's quite big. It's not their first acquisition. So Canva acquired Flourish in 2022, KDO in 21, Smart Mockups in 21, Pixels in 2019, and Pixabay in 2019 as well. So they've done a few acquisitions, but this seems to be the largest. What I'm going to find really interesting is a company started in 1987 that's more enterprise, is going to have a different culture and a different climate to what Canva is. Whereas the other companies seem to have been later, more startup-y, fast growth, bolt on to the existing customer set. Canva seems to be bulking itself up pre-IPO, now targeting the enterprise market, and is acquiring something for a reasonable lick of dollars that is just, it's going to be different, I think, to what they've done in the past.
Yeah, I think Canva's chasing a few things at once. I mean, that I picked up on that too, like the age of this company that they've acquired, at the same time shifting to enterprise sales, at the same time ramping up to their IPO. To what you talk about all the time, Don, there's a lot of change loops in there that will require reintegration. And look, they've got a track record of previous acquisitions, and presumably they've gone well, but there is a lot to take on at once. But yeah, best of luck to them. It's a great story for an Australian startup.
We wish them absolute luck, but integrating companies that are at the same phase of the life cycle as you is one kettle of fish. Integrating companies that are not only at a different phase of the life cycle, have a different sales motion, a different go-to-market motion, a different idea. Like when everything's different, it's a different ball game. Let's see how they go.
And it's not just M&A. We also saw the IPO of Reddit and Truth Socials, and Reddit climbing post-IPO as well. It jumped 40% on the first day of trading. And I was looking at it again this morning. It seems to be up
doubled
again. Yeah.
It's doubled now.
Far out.
And maybe that IPO window's back.
Maybe after all our talk of IPOs being non-existent, here's an example of one. Maybe it was just a lot of appetite in the market too that was pent up.
And that's often what happens with this, because this is all sentiment-driven bullshit capital game, right? You get a couple of wins, the narrative changes, everything starts to go. What is interesting, and there's a chart here for the listeners at home that goes back to 2007. The chart shows the share price in dollars. In 2013, at Series A was $2.67. Then in the Series B was $6.26. Then the Series C in 2017 was $15.77. The Series D, the share price grew again in 2019 to $21.69. Then 2021, the share price doubled to $42. Then it went up again in 21 to $61. Now, if you bought in at either the Series E in 21 or the Series F in 21, and you sold at the IPO price of $34, you're underwater. If you held, you're close to making your money back because it's doubled so far. But then when Truth Social launches, I have a sneaking suspicion that truth and the stuff that is actually spoken about on that platform, those words may not align, but that might just be me. It jumped 40%, which, given former President Trump's issues, he's a major shareholder, that might help him with his bond to stay out of jail. I'm not sure.
Yeah. So it wasn't a couple of bill, his personal value went up just with that. But yeah, this chart for Reddit though shows, like, for me, again, the place we play at around that pre-Series A, there's a reason we play there, and that's because we believe the risk-adjusted return, it's a sweet spot there. And this chart for me validates that.
Now, I think what's driving a lot of this is that big tech companies, and Nvidia being the primary one, is really putting a fire under this market. And Nvidia's continues to go from strength to strength. And it wasn't last week, it was the week before. But Nvidia came out with one of their big tech days and made 3 new product announcements, which was pretty amazing. One was the new Blackwell B100 and Grace Blackwell super chip. Right? These chips are made of 208 billion transistors. They're used inside racks of sprawling data centers run by many of Silicon Valley's biggest companies. Nvidia says Blackwell will make it possible to create AI models with 1 trillion parameters, which is significantly higher than previous AI infrastructure. So that in itself is another level up.
Yeah, I keep thinking of Joel Pobar's presentation at the 1013 event. They're just talking about dollars into that computational power in AI, and we just haven't hit the rate limiter. Like the computational power for AI that's coming through in terms of the modeling capability, we ain't seen nothing yet.
Yeah, no, it's amazing. And then they also announced Project GROOT, which is pronounced Project Groot, which I believe Groot is a type of humanoid robot, but it's a foundational model for specifically humanoid robots, which Nvidia says will further its work driving breakthrough in robotics and embodied AI. It also unveiled a computer called Jetson Thor based on its own chips, which it says is designed to perform complex tasks to interact safely with its natural environment. So
all I can say to our new AI overlords is listening to this podcast and going through it. You can't replace us with AI. Please keep us alive just for the human value.
Aaron, why, as soon as the AI listens to that and realizes in a split second that's bullshit, we're going to be the first. Couldn't you have offered to do menial tasks for them to keep us?
I figure just get it over and done with early. You know, the people who die in the movie right at the instant versus all those that carry on for the next 2 hours of the movie trying to survive. I reckon there's something in just get it done quick.
This is the anti-hero's journey. Yeah. Now, then the third one, Nvidia announced its inference microservice software to make it faster and easier to deploy AI solutions on Nvidia chips. Look, these guys are just pumping it out. And in hindsight, in earlier episodes where I've been referencing Cisco from the previous tech bubble, in no way is this comparable. These guys have hardware and software. They have an unbelievable head start because of what they concentrated on more than a decade ago. I'm not saying that still aligns to price or anything like that for their public stock, but any comparisons to previous cycles where companies that were just either software or just hardware, these guys are nailing both.
Yeah, I totally agree.
And one of the things that we saw last week, if not the week before, and I'll splice it in here, is the following video where the AI actually develops the software. The AI becomes a software developer. This AI is taking a text-based prompt of what the user wants, is going in, doing it, problem solving, and creating. Now, there's a little bit of human supervision, but it really supports our view that technology differentiation is going to zero.
Yeah, we'll just be managing the bots that are developing. It's really interesting when you think about growth studios and those that kind of manage the tech development on behalf of startups. Or I think if you get ahead of this curve, it's a super interesting place to be playing right now.
I think the ability for speed of iteration of little MVPs, doing little trials, doing little tests, getting stuff out into the market to see if it actually works, to see if anybody actually wants this. I see that as just being hugely valuable rather than waiting backlogged with your tech people.
I remember seeing there was a Silicon Valley company and they were using AI to read through patents and then through deductive reasoning come up with a new patent. Like to Sam Altman's point, we haven't yet crossed that threshold where rather than just deductive reasoning, where we actually AI can create a new hypothesis. I think that step change when we get to that. Can you imagine the concept of invention, like the very concept of creative thinking and invention completely changes?
I think that all gives rise to Ray Kurzweil was one of the early futurists that talked about the singularity. At some point, all of this is just going to join into one and we're going to end up in simulation after simulation. If we're not already in simulation after simulation, which Aaron, I know you believe, I just find it hard to believe given some aspects of this simulation seem so fucking dumb that someone with half a brain could have come up with a better, but anyway, and he believes that the singularity is going to hit in 2029. So we've effectively got 5 years of humanity as we know it left.
That's interesting. I didn't pick up on the 29, but yeah, because I remember he spoke at Singularity University, and when I heard him talk, he said 35. So it seems like it's been brought forward, fast tracked.
Yeah, coming forward there. Sometimes the people in charge of all of this stuff don't inspire too much confidence. Did you see the interview with the CTO of OpenAI? I'll play it. Just keep in mind, OpenAI leading the race here. We need to have confidence in the people doing this because of the effect to humanity. We want to make sure that they're understanding what's going on.
In touch with reality.
What data was used to train Sora? We used publicly available data and licensed data.
Videos on YouTube?
I'm actually not sure about that.
Okay.
They were publicly available, publicly available to use. There might be the data, but I'm not sure.
Yeah.
I'm not confident about it.
What about Shutterstock? I know you guys have a deal with them.
I'm going to go into the details of the data.
The look on her face, that first one that wasn't, I'm trying to come up with a better answer. That was genuinely, I've got no fucking idea.
Yeah. But I've heard this, people working quantum computing and AI saying they're not sure how some things are actually being done. And there was an example, which I need to find out the veracity of it, but there was an example of a black box AI project, and it had no access to external data sets other than what it was provided with. And it was asked to learn or provide an answer in a new language. And it actually did it. And they can't work out how it knew that language. If these things are true, that's a scary thought. But what is scary here is the inability to actually answer the data sets it's trained on, but also the biases of public data, like how much stuff is on the internet that is total BS that someone's just put out there as their view of the world that we are training these data sets on.
The conspiracy theorists always believe that there's orchestrated things occurring where really clever people rule the world. But actually, it's just a series of humans just doing human things, and with all the human frailties, and often they don't know shit.
Yeah. I always find, just speaking from my personal family experience with some relatives, that those that are avid conspiracists, that the governments have deployed these massive conspiracies against humanity and complex and kept it secret, are also the same government departments that they whinge about for their total incompetence and inability to actually do anything.
Yeah. And we saw it with the debacle of Sam and OpenAI and whatever else. These are just early stage companies, right? Doesn't matter how much money you've got, or you can't get away from life cycle development issues. And in early fast growth companies that don't have the systems, the process, the controls, the predictability, it is this messy wash of shit happening. But we expect so highly of them. But anyway, just don't expect the CTO to understand where any of the data is coming from. Why would we expect that? Let's just do our quick week in charts. There's a few random ones in here. So what I've got up for those at home is that there was an unexpected drop in Australia's jobless rate reported in the media, down to 3.7%, right? Stronger than expected. 116,000 people increased employment, well above expectations. Now, a conflicting bit of that, Andrew Kenobi posted, the only thing we can say with confidence after today's labour market lottery is employment probably isn't 3.7%, and we almost certainly didn't add 116,000 jobs in February. And what he put was the inverse of Seek job ads and the unemployment rate. And what we're finding is that the Seek job ads is plummeting. That's an invert. And unemployment is going in that direction as well. And so often what I've seen is that this stuff gets restated later, but he's obviously calling bullshit on that data, and he's using the Seek job ads to justify it. We can see what happens after the last 2008 crisis. Those job ads plummeted. Then at the beginning of COVID, job ads plummeted, only to increase. And what we're seeing is ads just keep plummeting. And that, I think, is an interesting precursor. Now, keeping on the employment theme, Double Line Capital came out with a chart going way back to the 50s that shows average hours of weekly worked manufacturing roles. And what we can see is that is continuing to decrease. And what Double Line say, average weekly hours worked in manufacturing is sliding very quickly. First, they cut your hours, then they cut the bodies. That's the way the economic cycle works. And so what they're putting forward is that this is a precursor to more job losses. But first you get your hours cut, then you lose your job. And if you have a look at those cycles going all the way back to the 50s, It's a pretty good rhythm pre-recession. Now, another one, the US employment rate, going back to, again, the 1950s. Like, this chart is just a beautiful swing chart for the listeners at home. A body in motion tends to stay in motion. Once employment starts ticking up, tends to just keep going up. Once employment starts to fall, just continues to fall. So it's from the 1980s, started at 5.6% up to 10.8%, then down to 5%, then up to nearly 8%, then down to 3.8%, then up to 6%, down to 4%, up to 10%, down to 3.5%, up to 14%. Now it's down to 3.4 as the low. It's currently 3.9. But if history plays out, a body in motion tends to stay in motion. We're potentially heading higher.
The other thing from this chart for me, the unemployment rate rises much faster than it decreases.
Yes.
Like that impulse straight up.
Once it starts, something happens.
Yeah.
And another chart for those at home is the percentage of interest payments going on disposable income. And again, that's a bit of a wave. But when on the second part of the chart, it's the rate of change percentage. And again, going back to the 50s, we have never seen a rate of change faster than what we've seen, faster and higher. And we're almost back to some peaks back in the 80s and 90s in terms of percentage of disposable income. But the question becomes is, with such a rate of change, is it possible to actually have a soft landing? It's just a question that is posed. But if we look at the unemployment data, it's certainly pointing in some direction. Now, I thought this was relevant just for Easter. No, this isn't a price of Bitcoin. This is the coca futures has gone from normally it's somewhere between $2,000 and $3,000 a ton to nearly $10,000. And the reason why that's happening, another chart, is that this is the number of ton of coca. This chart is either the surplus or the deficit in tons of coca based on what the demands are. And you can see we've just had this historical deficit. We've never had a deficit of minus 400,000 tons of coca. And we've been in deficit for now, this is the third year. And that is leading speculators to say coca and therefore chocolate prices are going to go through the roof. My advice this Easter is buy up big, because if those future prices are correct and that flows into the spot price, hold on to some chocolate eggs.
I saw this a while back, this prediction of the supply hit, and I was explaining it to my kids, trying to convince them not to eat their chocolate, but to hold on and in the future sell it to their mates, but they just ate the chocolate.
Yeah. There you go. And then I just thought this was interesting how the world speeds up. So when the first gold ETF came out in 2004, it took 27 months, so more than 2 years, to cross 10 billion. The first Bitcoin ETFs, and people equate Bitcoin to be digital gold, the first Bitcoin ETF and money going into that took 7 weeks. So the world is getting faster. The world is getting more exponential, as we know.
Yeah.
So that's this week's random charts.
It's a good wrap. Always something interesting in there, Don. Always something random. This week, we're talking chocolate.
Yeah. So what are we looking forward to? I'm looking forward to hopefully finding that we can, in fact, go to the farm as a full family, but I guess I will find out about that shortly.
Jack, what are you looking forward to?
Same thing, but my family's got a property 45 minutes from where I live. So yeah, going out there this weekend.
Is that the one where your sister got married?
Yeah. Yeah, that's the one.
Oh, that's an amazing pad.
For me, I'm looking forward to this weekend catching up with friends. There's been a couple of birthdays in the group, and so going to have some dinners and parties, which will be good.
Do we believe that, Jack? Friends?
Hey, if they're imaginary, it still counts when you're in a simulation.
Yeah. Yeah. No, that's good. All right. We'll catch you on the other side.
See you guys.
Cheers.